Welcome to ACCA Academy YouTube channel. In this lecture, I want to examine market size and market share variance. If you are coming across my lecture for the first time, please like the video and also share it with others. If you are a returning subscriber, I say thank you for being part of this channel. Sales volume variance. Sales volume variance can be analyzed into market size variance and market share variance. Market share variance. Market size variance is the planning variance. Planning variance. While market share variance is the operational variance. Operational variance. If you have considered or if you have watched my earlier lecture on planning and operational variance, I've told you that in planning variance, you want to compare the initial target with the latter target. And the initial target is called S and T, while the latter target is the X post. This is initial target set. Initial target set. That is X and T. While the latter target set is called X post. For operational variance, I've told you want to compare the X post with actual. You want to compare the X post with actual. So market size variance. Market size variance. Remember, I've told you in market size variance, you want to compare the X and T with the X post. Therefore, market size variance will be equal to X and T market size, X and T market size minus X post. Market size, X and T market size minus X post market size times budget market share, budget market share multiplied by standard profit or standard contribution. Standard profit or standard contribution. So, market size variance is equal to X and T. X and T market size minus X post market size multiplied by budget market share times standard profit. The standard profit, if you want to use absorption costing school of thought, why standard contribution for marginal costing school of thought? This is formula 1. Formula 2 for computing market size variance. You can equally compute the market size variance using this formula. Remember, market size variance, I've told you it is the planning variance. Planning variance for sales. The planning variance for sales is called market size variance. While operational variance for sales is called market share variance. Please take note of that. So, if you want to compute market size variance, if you don't want to use this formula, you can equally make use of this. Ex ante market share, ex ante market share, ex ante market share minus ex post market share, ex ante market share minus ex post market share multiplied by standard profit. Standard profit. That is, if you are using absorption costing school of thought. But if you are using marginal costing school of thought, you make use of standard contribution. Standard contribution. That is market size variance. Remember, I've told you the second variance, let me call that B, which is market share variance. I've told you market share variance is the operational variance for sales. Operational variance. Remember, in operational variance, you are going to compare the ex post with actual. Ex post minus actual. That is operational variance. If you have watched my earlier lecture on operational variance, then you will understand this better. I will advise you to watch my earlier lecture on variance analysis for better understanding. Therefore, market share variance, market share variance, remember I've told you it's operational variance. In operational variance, we are comparing the ex post. So you have ex post market share, ex post market share minus actual market share. Remember, we use the word share, not total market. Unlike the market size variance, where I made use of S and T total market. Please don't forget to put total there. This is total market size. So include total here in this formula. So, but this one, you don't need total here. It's share of the market. So, S post market share minus actual market share multiplied by the standard profit. Standard profit for absorption costing school of thought. But for marginal costing school of thought, you may use of standard contribution. Standard contribution. So I'm going to take a question as work example. Example. Brunco prepared a sales budget based on an estimated market size of 200,000 units and a budgeted market share of 25%. Standard contribution per unit, 40 naira. At the end of the year, it was estimated that the actual size of the market during the year had been 260,000 units. Actual sales in the year were 61,000 units required. Calculate for the year. A, the total sales volume variance. B, the market size variance. C, the market share variance. Now, let's have the solution to the question. Solution. So, in A, you have to compute the sales volume variance. Sales volume variance. Remember, if you have watched my earlier lecture on sales variances, I told you that sales volume variance is budgeted sales, budgeted sales volume minus actual sales volume multiplied by standard profit for absorption costing school of thought, but standard contribution for marginal costing school of thought. In this question, what we were given is standard contribution. So that means you are expected to make use of the marginal costing school of thought. Therefore, the weight here should be standard contribution. Standard contribution. Standard contribution. So, what is the budgeted sales? Go back to the question. You were told Brunco prepared a sales budget based on an estimated market size of 200,000 units. This is the market size. And the budget market share of 25%. The budget will be 25% of the market size, of the budgeted market size. No estimate is the same as budget. Budget is an estimated figure. So this is estimated market size. Budget will be 25% of that. So budgeted sales, budgeted sales, that is 25% of 200,000 units. That gives us 50,000 units. That is our budgeted sales. Then what is the actual sales figure? Actual sales. Back to the question. Actual sales in the year were 61,000 units. So the actual sales is 61,000 units. 61,000 units. Now let's substitute into the formula. Budgeted sales, 50,000 units. Minus actual sales. Actual sales is 61,000 units. Multiplied by standard contribution. And our standard contribution is given to be 40 naira. Standard contribution per unit, 40 naira. So multiply by 40 naira. $50,000 minus 61,000, that gives us 11,000. The difference between this is 11,000 times 40 naira. Then you have 440,000 naira. Therefore, sales volume variance equals to 440,000 naira. Now, the actual sales volume is 61,000 and it's more than the budgeted sales volume of 50,000. The number of units sold is more than budget. So it shows that the variance is a favorable variance. So we have a favorable variance of 440,000 naira. That is sales volume variance. That is the solution to the A. Now, B, the market size variance. B, you have to calculate the market size variance. Market size variance. I've told you that this can be calculated in two ways. So since market size variance, I've told you is the planning variance. Remember, in our planning variance, you are comparing the ex ante with the ex post. Therefore, you have the ex ante total market size minus ex post. total market size multiplied by budget or budgeted market share, budgeted market share times standard contribution. Standard contribution. Standard contribution, because it is contribution that is given in the question. So that is to show that you are expected to use the marginal costing school of thought. Back to the question. Now, the ex-ante market share is 200,000 units. Then at the end of the year, it was estimated that the actual size of the market during the year had been 260,000. Estimate is not yet the actual. This is still budget. So it shows that this is the ex-ante, which is the initial target. This is the latter target. So ex-ante total market size is 200,000 units, while the ex-post is 260,000 units. Ex-ante total market share is 200,000 units. 200,000 units. While ex-post total market share is, total market size rather is 260,000 units. 260,000 units multiplied by budgeted market share. Back to the question. The budgeted market share and the budgeted market share of 25%. The budgeted market share is given to be 25% times 25% times standard contribution. Standard contribution. We are given the standard contribution per unit of 40 naira. So times 40 naira. So 200,000 minus 260,000, that will give us 60,000 units times 25% times 40 naira. 60,000 times 25%, that gives us 15,000. 15,000 times 40, so we have 600,000 naira. Therefore, market size variance. Market size variance is 600,000 naira. Now, the ex-post is greater than the ex-ante. So it shows that it is a favorable variance as well. I've told you that the market size variance can be computed in two ways. It can be computed in two ways. Another method of calculating that is ex-ante market share. We have ex-ante market share minus ex-post market share multiplied by the standard contribution or standard profit. But based on this question, it is marginal costing school of thought. So we may use our standard contribution. Back to the question. What is the ex-ante market share? The budgeted market share, market size is 200,000 units. So ex-ante will be 25% of 200,000 units. Since this is the initial target, which is the ex-ante, 25% of 200,000. So ex-ante market share, that will be 25% of 200,000 units. That gives us 50,000 units. So ex-post market share, exposed market share, that will be 25% of what is the latter target. So the exposed, we have that to be 260,000 units. So we have 25% of 260,000 units. That gives us 25% of 260,000. We have 65,000 units. So let's substitute into the formula. S&T market share, that is 50,000 units minus exposed market share, which is 65,000 units. Multiplied by the standard contribution. And how much is our contribution? The standard contribution is 40 naira. Multiplied by 40 naira. $50,000 minus 65,000, that would be 15,000. 15,000 times 40, that gives us 600,000 naira. 600,000 naira. It is a favorable variance because S post is greater than the X and T. So this is our market size variance. So the result obtained is the same with what was obtained from the first method. Now, C. In the C part of the question, you have to compute the market share variance. Market share variance. Market share variance. Remember, I've told you the market share variance is an operational variance. Operational variance. Being an operational variance, you are comparing the exposed market share with actual. So we have exposed market share minus actual market share multiplied by the standard contribution. Standard contribution. Our exposed market share has been calculated. We have the exposed market share and we got that to be 65,000. We have 65,000 units. That is the exposed market share. 65,000 units minus actual market share. The actual market share. The actual sales in the year were 61,000 units. So we have 61,000 units. Multiplied by the standard contribution. Standard contribution per unit is 40 naira. So we have multiplied by 40 naira. 65,000 minus 61,000, that will be 4,000. 4,000 times 40, that will be 160,000. Therefore, market share variance, market share variance is 160,000 naira. So the actual market share is lower than the exposed market share. So it shows that this is an adverse variance. Adverse variance. Now let's have the summary of everything. Summary. Remember, the market size variance and market share variance should give you the sales volume variance. So we have the market size variance plus market share variance market share variance. The sum of the two will give us the sales volume variance. And our market size variance was 600,000 favorable. 600,000 favorable. That is market size variance. 600,000 favorable. Then market share variance. Market share variance, that is 160,000 adverse. 160,000 adverse. If you add the two, no adverse is negative. So we have 600,000 favorable minus 160,000. 600 minus 160. That gives us 440,000. 440,000 favorable. That is sales volume variance. If you compare this figure with the result obtained from our computation of sales volume variance, we discover that the results obtained are the same. So this marks the end of the solution to this question. In my next video, I will take a comprehensive examination questions from workout performance management. Please drop the love emoji, also share the video with others. Thanks for watching ACCA.